This is a very special chat we are having today with a gentleman who's been an authority on security analysis and value investing, Professor Stephen Penmen, who's visiting Mumbai right now. He's a professor in Columbia University, where Mr. Ben Graham was once a professor, and he's been in the teaching of finance accounting principles for almost 4 decades. Professor Penman, thank you very much for chatting with us.
A very pleasure to join you.
Value investing is a subject which you have really gone through for decades, and value investing is becoming very popular in the Indian market as well. Many of our viewers follow that in their own investing practice. Talk to us, what is the essence of value investing? What's the secret behind successful value investing?
I think that just one word is information. Getting information to understand the business of a firm and how that's going to transpire into its financial statements. Without information is gold. Information reduces your uncertainty. Information reduces your risk. So the key is to get the information. The target of the information in value investing is to discover, as Benjamin Graham, who you mentioned, would say, I want to discover where price is different from value. Price is what you pay and value is what you get. And so you want to pull that information together, get an understanding of where there's opportunities where price is different from value. So it's active investing. It's different from buying a passive index fund where you're just buying a basket of security of stocks and you're exposed to the risk in those stocks. It's saying, let me go through that basket and work out those which I want to buy and which I don't want to buy based on the information. Mm-hmm. But the key is information.
Mm-hmm. There's also, a lot of times people get confused between value and low price, and they fall into value traps. How can we evade that? How can investors steer clear of that and still find high quality company that good value, attractive value?
Well, again, information, okay? You find that by information, and there are traps out there. The traps are, you see good companies and you think, I buy good companies. No, you don't buy good companies, because good companies can be bad buys. There are firms that trade in low multiples, low price earnings ratio and price to book ratios, for example, which turned out to be not good investments. You're buying risk. So you need to go in and understand that pricing. Is that price earnings ratio a good price earnings ratio? Price earnings ratio is based on growth, so you're buying growth. And so one of the mantras of value investing, it's Benjamin Graham again, he said, beware of buying growth because growth is risky. So buying a price multiple is buying growth, and you've got to be aware of the riskiness of it. So it's a deep analysis of risk as well as what the earnings payoffs are going to be. That's the key to it.
What are the key differences in your view between the two approaches, value investing and growth investing?
Well, value investing and growth investing, in my mind, is a bit of a misnomer, okay? It's fuzzy thinking. All investing, in my mind, sensibly, is value investing. I can buy good value in growth. One of the Benjamin Graham's notions was, I don't buy growth because it's risky. And one of the complaints about Benjamin Graham's approach was, whereas in his days, where we're thinking about the 1940s, the 1950s, you could find companies which are underpriced without building in growth. The complaints was that he would have missed out on one of the great growth companies of the last half of the 20th century. He would never have bought IBM, okay? Because it is buying growth. What modern value investing does is says we bring the two together. We really think about buying value in growth. And most new companies, your technology companies, your new service companies, many of your new economy Indian companies are based on growth. It's a growth economy here. They're relying on growth in the world, and having systematic ways, disciplined ways of buying that growth, that's the new edge to value investing. So the difference between value and growth in that term, in that framework, it goes away. Mm-hmm.
The 3 most important words in the field of finance, they say, are margin of safety. And a lot of times investors perhaps pay much more emphasis on returns, potential returns, compounding returns. They start perhaps giving lesser weightage to the kind of risk which comes alongside. How, in your view, should investors approach their calls so that risk as well as return, equally importantly, is taken account in?
Yeah, risk goes with return. Return goes with risk, and you've got to understand. You've got to understand the understand the risk. Margin of safety is a very important concept. And I can put it another way. Very often in finance and investment, we talk about the business risk. We talk about beta risk. We talk about the betas of stocks. These are actually important concepts and things you have to deal with. But the primary risk of investing is the risk of paying too much. Okay? So the idea that you pay too much for a stock, that is your biggest danger. So actually finding stocks where value is less than price is very important. So that's the first way to deal with risk, and that's a margin of safety. I don't buy stocks that maybe they're reasonably priced or maybe they're overpriced. I try and find stocks for good returns that I buy with a margin of safety. With some good conviction, I understand that this actually is a pretty good risk. Anything can happen, of course, in this world, this uncertain world, but I understand I do that with a margin of safety. And one way of doing that, when I think about risk, I think about how am I going to apply a discount rate? If in fact you think it's a reasonable rate of return, as you say, is going to be, let's say, 10%, and in the US market we'd probably say 8% in this environment is a reasonable rate of return. If I can find one that's going to yield me 10%, then I have a margin of safety, because actually, as it were, I cover my required return of 8%.
In fact, one of the most actively used tool for arriving at the right valuations world over is discounted cash flows, and in India too, a lot of fund managers and analysts use that. You have been talking about why discounted cash flows, of projecting cash flows in future and then discounting them, perhaps may not be a very accurate way of arriving at value. How do you analyze that?
Yeah, that's a correct statement. I think discounted cash flow analysis, which, as you say, is a very common technology for valuation, is a very speculative technology. First of all, it forecasts free cash flows. In the terminology, in the accounting of free cash flow, it's your cash that comes from your business minus your cash investment. And so firms that invest a lot have negative free cash flows. I don't know India well, but I'm told a lot of firms have negative free cash flow because it's a growing economy, they're investing, okay? So if, for example, I wanted to forecast free cash flows, and actually the free cash flows are negative because of high investments, I don't have much to land on. I've got to draw a sort of a forecast for the long run, how these investments are going to pay off, but that's very speculative. And what you're doing all the time is you're ignoring the balance sheets where the investments are, and the income statement, which is the return on the business. So I follow an approach of emphasizing the income statements and the balance sheet rather than the discount cash flow. Free cash flow, in my mind, is a perverse measure. You have lower free cash flows the more you invest, and you have higher free cash if you liquidate your investment. That's perverse.
Fair point.
That's not a way to account for it. You've got to think, how do I invest, get value? I invest and I add value to my investments. That's the way to think about it.
So you're making a point that negative free cash flows also, or a medium term, may not be a bad thing.
Negative free cash flows are very often very good things. Of course, in the long run, you want to have positive free cash flows because those investments have to pay off. But if valuing a stock now, the long run is a very long time. As Keynes said, in the long run, we're all dead, okay? And have to forecast the long run is I have trouble with as a value investor. If the free cash flows are negative now, that may be a good sign. They're investing, so I want to understand those investments and the profitability of those investments. Okay, I can see that. And so you have many examples. I have a number of examples in the seminar here. Starbucks in its early days, negative free cash flow because they're investing. Now they have positive free cash flows. Walmart, for 50 years, negative free cash flows. Any expanding firm, negative free cash flows. You can't handle that, okay?
Right. The other thing I wanted to have your opinion on is that value investing, a lot of people consider smaller market capitalization companies attractive, low valued companies, and larger companies as fully valued or fairly valued. On the other hand, some people say that valuation of a company, the market capitalization alone is not a metric. Do you think that this is also a confusion a lot of investors fall in, not necessarily smaller companies have to be attractively valued?
I think you're right that larger companies tend to be more reasonably valued, okay? Because there's a lot of information around there. There's maturity in their financial statements. They have sales, they have margins, they have growth. There's a lot of analysts following them, okay? But market cap itself is not necessary. You can find large firms. I mean, I bought Apple a number of years ago. Warren Buffett's bought Apple. It's been a great investment. It actually has the highest market capitalization. And I think it's still a reasonable investment. But on the other hand, it's more likely in those mid-cap and the smaller cap firms that you're going to find the value that's going to be worthwhile with the margin of safety. However, I must say, in that case, it's got a lot more diligent work. There's a lot less financial information around, getting to know the business, and the business is going to take a lot more legwork in terms of getting that information, which I said is very, very, very important. And they tend to be more risky too. They're growth companies, the growth may not pay off.
So my last question is about the point you were making earlier, that more legs on the pavement is the strategy which value investors should adopt and deploy to find those hidden gems in the market. Apart from that, because our viewer base is also, many of them are aspiring value investors, couple of ideas if you can give them, how should they make themselves better value investors?
Well, I think you put the nail on the head, hit the nail on the head. The first thing, the best information is the business information. So it's a basic rule of value investing is you understand the business. So if you're going to do it thoroughly, and I must say not everyone does it thoroughly, and I must say I don't do it thoroughly because I haven't got the time to put the boot leather onto the pavement, okay? But the best value investors are those who go out, and in the old days they would see the number of people working in the shops and see walking the shops and seeing the transaction. Now they have the satellites will tell them that, okay? Or they go to Uzbekistan and find out there's a company which really has high prospects. But that's not sufficient. Then you do have to do the financial analysis, and that's where my sort of work comes in. As you mentioned Warren Buffett before, he buys businesses. He buys businesses he understands. A value investor doesn't buy a business that he doesn't or she does not understand. But then he goes and reads the annual report, okay? And he puts into accounting returns, because you can only convert your knowledge of the business into a valuation if you actually start doing the accounting. So the two things go together, but I must say the business analysis is most important. Right. Most of us don't have the time to do that, okay? But you recognize when you don't do that, you're running some risk of not getting the information.
Any opinion on the Indian market or Indian economy? I know you do not track it actively, but whatever you've maybe read or gathered from
I've got to confess I have no opinion, and I wouldn't like to draw an opinion. It's good to see things prospering. It's just the reflection is that this is a growth economy. If things stay on track in terms of growth and the political situation, I imagine it was a very good place to look in to invest. I wish I had more time to put the boot leather on the town to pay for the pavements in India to find that. But potentially I would expect there are very good advantages to sound value investing in India. But please, I cannot tell you where the stock markets are because one thing a value investor does is says, understands what you know and what you don't know, and you don't get into something you don't know, and I don't know India.
All right, Professor Penman, we'll let you go on that one. Thank you so much for your time and wonderful chatting with you today.
Nice chatting to you too.
Thank you very much.